Hey, good morning, everybody. Welcome to Trading Index Options. I'm Connie Hill, sitting in for Ben Watson here today. Some of you may have been aware of index options for a long period of time, and for some of you, it is a newer type of approach that you're being introduced to here. Those of you that have been trading for a while, I'd like you to chat in. What do you find to be the most appealing thing or the most appealing aspect of trading index options? Okay, we're going to go into some of those virtues that they might have here today in our discussion. Now, I am joined in the chat by Cameron May. I'm happy Cameron's here. He's a great veteran of the market and friend. We just reversed. We were in the same role last night as we finished up. Anyway, I was teaching. Cameron was on chat. Anyway, he can help answer some questions maybe I can't quite get to, bring in some different resources that might be helpful to you. Okay, I hope you're following us on X. I'm Connie Hill CS. He's Cameron May CS. We'll post educational content and things maybe we're noticing in the charts, things that might raise a question that we think might be useful and helpful to you. We want to share those things with you. So it's free, it's easy to do. Go ahead and do so. Just want to get a quick hello into some of our early birds here this morning, starting with Reggie. I think Reggie got to be here in first place. Lola, Kevin, Ted. Let me scroll down here. Kelly, Chris, Mighty Mouse, RTR. Glad that you are all here today. Let's go through our disclosures, and then we'll talk more specifically about our agenda here today. And again, the question I asked is, what is appealing to you about index options? Okay. What we talked about today is for information and general purposes only. Don't consider it a recommendation. Past performance is no guarantee of future results. When we talk about different ticker symbols, they're just being used as examples here in our presentation today. We won't really be taking into consideration commissions or other transactions fee, but no, those are something you want to make sure you're considering. American style short options can be assigned at any time. What we'll be talking about today are going to be European style. And so we don't have to worry about that early assignment. There is no guarantee that an execution of a stop order will be at or near the stop price. That's just going to be the trigger mechanism. We will be using the Paper Money software application. That's what you download to your computer. It's fabulous to get to know the Thinkorswim platform using that Paper Money side. Keep in mind, it's not perfect, but it is for information and educational purposes here today. All right. Want to give you a nudge, if you need a nudge, to attend one of our upcoming workshops or market drive events. Last weekend, it was in Chicago. It was a fabulous event. Heard from several of you saying, man, that was really good. I'm so glad I went. So if you're in the Dallas area, September 20th could be a good time for you. If you're in Chicago area-ish, October 4th, and then Orlando will be a workshop. The 10th and 11th. So if you have any interest, go ahead and sign up, because some of those places, they get filled early, all right? And then once it's closed down, then they don't allow, there's nowhere to put you. You can't stick you on the ceiling or something like that to attend. So we have to close down the registration. So if you're interested, get yourself there. All right. As far as our agenda goes, we always want to talk about some aspect of index options. And, you know, as I mentioned earlier, some of you, this might be, or index options might be a little bit newer too, and others of you that have been around the block a few times, index options are they're old, okay? But I am going to go back to see what you said might be what is appealing to you. Of course, we're going to talk about some different strategies here today. That does a great job of highlighting a lot of different types of strategies that you could use. And of course, we're always going to be looking at some examples. So I'm going to go see here. Harry says, being able to create a short vertical near the money without fear of early assignment. Hey, that's one of them. Kelly says the same thing, no early assignment as well as stability. Let's see if there was anyone else that made a response there. Hey, I have to say hello to my neighbor. Oh no, hello from Saratoga Springs, Utah, George. That was actually Cameron. Cameron and I live in cities pretty close to each other. Lola says no earnings. yeah, you don't have to deal with earnings dates, earnings surprises, right? It's just not a thing. Ted likes the European style of them. That goes back to that no early assignment possible, cash settled, stability. Yeah, you guys are hitting some of those main points about what is appealing about these index options. They can be used for a wide variety of purposes. Okay, so they do have some flexibility there. Many times we're going to be using something that's a large index, right? Like the S&P 500, the Russell 2000. And so you have that diversity in there of that basket of stocks and overall representing what that index is doing. One thing people really like using, and this may be appropriate for what's going on in the markets right now, is maybe for some hedging purposes. And maybe instead of hedging each individual position, right? You have some stock positions, and then you don't have to go out and do an individual assessment of, oh, gee, how should I hedge this position? Oh, okay, maybe I'll sell a call. Maybe I'll buy a put. Maybe I'll do a collar. And that definitely is something people could do. But if you were just saying, I've got this big portfolio, I want to hedge the whole thing, that's where using some of these index options could be really helpful for you. We've mentioned the cash settlement, that it's European style. We're going to talk a little bit about liquidity of these indexes. Let's hop over to Thinkorswim here. I appreciate you guys kind of pitching in. Tell me what aspect you really are liking. At the beginning here, I think it was Reggie. No, it wasn't. It's John the Noble Savage wants to know what chart I'm using, what I've got on my charts. Why am I highlighting whatever it is on the chart, as he's trying to get settled with his charts and what he likes to look at. Today, we're going to be pretty simple. Okay, we are going to have a red line that's the 30-period simple moving average. This green line down here is a 200-day moving average. So it gives us the idea of what's the longer term trend, what's the intermediate trend. Looks like today, we know the SPX is pulled back here a little bit. Looks like maybe barely off its lows at this point in time. I have the RSI down here. And the RSI is a great gauge of conditions of, is it oversold? Is there over bought conditions of an index or stock that you're looking at? One of the real virtues of RSI, and I've been talking about this the last couple of days, is that it's really good at pointing out when we have a divergence. And a divergence simply means that what the price action is doing, like making higher highs and higher lows, we would expect our indicators to be doing the same thing. As we hit a higher peak, we would expect the indicator, like the RSI or the MACD, whatever it is you're looking at, to go higher as well. And when it doesn't, that's when we have what we call a divergence. And so I've drawn a couple of them in here. We had a divergence back here first part of July where market kept hitting new highs, but the RSI didn't. And what that means is something could be changing. Now, you can obviously tell, well, gee, nothing really changed a whole lot. Yeah, a couple, 3 month ago, I guess it was, we had this pullback, right? But in tracking it here again, it just put in another all-time high. And we would expect this RSI to be up here. We would expect it to be higher, but it didn't. It didn't go higher. And you can see I've drawn this horizontal or diagonal line here indicating, gee, we're having lower lows on the RSI. And so it's something to be aware of. Typically, anytime you see a divergence, it doesn't mean, throw everything out, but it does mean, things might be changing. Let's pay good attention here to see if things are changing and let price confirm that there was a change, because back here we had this diversion, but price kept climbing higher. So price did not confirm the divergence that we were seeing at that point in time. Yeah. Quick question here, and maybe Cameron can help with this one. Wondering how you can register for the Orlando event. Actually, I'm going to show you. It's probably easier for me to show you. Answer that question. DJT says, can you do an example index option hedge trade? We can, let me see if I can work that in there. Okay. we might be able to do that, even if it's just kind of a little one-off. Let's go over to my browser window here. We're going to go to where I have the, over here, this tab, I've logged into my Schwab account, okay? When you log into your Schwab account, go to the Learn menu, come down here to Schwab Coaching. It's going to take you to a landing page here, and you can see this is where you can find our webcasts, on-demand webcasts, as well as in-person events, and that's what is being asked here about the Orlando specifically. So come down here, and where it says in-person events over here on the right, bright blue lights, go ahead and let's hit view the calendar. And then we're going to scroll down until we see Orlando on the 10th and 11th. By the way, Friday, October 10th, I have to tell you, is my favorite day of the year. It's 10-10, and it's not my birthday, but I do like that. I don't know, I like numbers that do that. Anyway, here is Orlando. If you want to register for it, click on the Learn More. You don't have to register for both days, but you can, right? If you have availability to be there both days, go ahead, be there both days. But maybe you can only do Saturday, not a problem, just register for that day. Okay, click on there, it'll take you into doing that. And Cameron's sharing a resource with you there as well. Okay. Going back to my charts here. The other thing I have on the screen is a probability of expiring cone. Now, I was in this class a couple weeks ago, and we really went into depth about the probability of expiring cone, what it is and represents. I'm not going to go through that today. I will put a link to that in the notes that I create for after the class is over. I'll put a link in there for that, or you can go if you've gone to become a subscriber to our Trader Talks channel. There's a little link lower right hand portion of your screen. You can click on that and become a subscriber, and then it makes it really easy for us to find out our content. In fact, okay, I'm just going to jump there for a second. Okay, here's our Trader Talks. You could come down here to playlists and then come back and find index, trading index options. Should have Ben's face on it. I'm going to scroll down here a little bit till I see more of Ben's face. In any case, then you can find our playlist for that particular class. You could go in, and if you're like, after I made reference today to the probability cone, you might be interested in a little bit more detailed information about it. Okay, this probability cone that I have sitting here is, we're going to use it as a reference here today. Basically, the thing that you need to know about it is this probability cone, as it's outlined here, is just graphing for us the theoretical bounds that we might expect, whatever we're looking at. I've got the SPX up here, that we would expect the price of the index as we go out in time to be between these two boundaries. Okay, it's a 1 standard deviation from the mean, which means it encompasses 68% of data points, meaning, you know, we're expecting 68% of the SPX values, where it runs, where it trades, to be inside this cone. Now, it's not guaranteed to be there. If we wanted to take in more, we could do 2 standard deviations from the means, which would be 95%. But for our purposes and what we're looking for here today, 68% is great. Okay, so just know that's what it represents, and we'll make reference of that here today. Breaker says, I use the probability chart. I love it. Are you talking about this cone here, Breakish? It is. It's very helpful for certain strategies that you might be considering. Yeah, very good. All right. Great. What might we look at? One thing I wanted to talk about a little bit here before we get into specific trades is liquidity. Now, 2 weeks ago, I was here and we put on a trade. We'll go look at that trade. And that trade, I'm going to get rid of the other classes, was this SPX trade. And we just simply put on a put spread. Okay. We brought in 50 cents on that spread. And now it's worth nothing. Okay, it's due to expire today, and our intent last week was to put on the spread 2 weeks out, close it down a week later in class. Well, I wasn't with you in your class, so I didn't do it, okay? So it's still sitting there, but that was the intent of it. But if we come over here, and this is the option that expires today on the 20th. So if we come out here and let's bring up where our position is, actually, that strike price, 61.25. All right. Let me open this up. I think we're going to have to look at all strike prices in order to find it. Okay. Let's scroll down here, be looking on this side. Oh, there it comes. Here is that position. And you can see it is way, way, way out of the money. Delta is 0.00000 up for a long stretch through here. That basically means, man, it is way out there. Okay. So we could be in a position that maybe it can just expire worthless and we really probably don't have to worry about it, although the intent was to close it out last week. Okay. But what I want to draw your attention to here, and I'm going to go down maybe a little bit closer to at the money. I want you to see the liquidity in these SPX options that expire today. Here's our open interest, which is the basic balance of contracts out there. Lots of these strike prices have thousands. It looks like all of them have at least hundreds of contracts out there. And then look at today. This is today's activity. The market's only been open for not even a couple of hours here. Look at the volume of activity out here in these options. 2,000, 3,000, 7,000, 5,000, 8,000. There's a lot of trading going on out here, not just with the puts. These would be deep in the money calls, so it would probably look a little bit maybe more out of the money here to see that activity. Look at this. Look at this, 20,000 contracts today on that 63.75 strike price. Why do you suppose there is a lot of volume activity today on the call side compared to the put side? I mean, the put side does have some, right? Here's the volume column here. You know, these at the money options. Yeah, there's a lot of activity there. And that's one of the reasons that people are drawn to it, is because of the possibility of the different strategies that you could work with it. But knowing just narrow bid-ask spreads and tons of contracts, so you know it's easy to get in and out of. Some of you may not have experienced this, but you might be had the experience of being a trader that maybe did some option strategy, whatever it might have been, where there was really low open interest, and then you're trying to get out of it, and you're like, oh, the market maker made it really wide, the spread. Man, that is not advantageous to get out of this point because the spread is so wide, right? And those are the kind of things we're hoping to avoid. And so index options possibly do that. Okay, I said, why is there so much activity out here? Joe says, well, it's because of the 0 days to options expiration. Yeah, these expire today. Now, we're not going to trade anything today in our class on this series, but I did want you to notice that open interest. Lola says, well, maybe people are speculating there's a bounce. Could be. Or it could be that people are seeing these are out of the money on the calls. How likely is it that the index today will close at 6,400? Well, where is 6,400 today? Well, 6,400 is not that far away. It's pretty close to out the money right now because we're at 63.70, right? But if we could go beyond that, and let's even just stay today, we could get outside of the probability cone. You know, somebody might be interested in saying, oh, well, this is outside the probability cone, and actually we're clear down there. So outside the probability cone today might be, let's go 64.20. Okay, it's just barely outside of the cone. 64.20. So on, let's see, here's our 64.20. How far out of the money is this? If we were, let me go back here for a second. If we were looking maybe outside the boundary, maybe 64, what I say, 20, and then on this side, maybe 60, 63.30. Okay, let's go to 63 or 63.30 in here. That's actually in the money on this one here as well, but we could come over here and it's at about 11 delta. expiring out of the money. So is it likely to go there? Well, not highly. It's actually 89% likely to expire out of the money. That's a pretty high probability. When we're talking about probabilities, we're doing some maybe 20 to 40 days out. We'll look for like a 60 plus, right? Well, here is a lot less time. They're going to expire today. And so some people might be going, maybe just sell way out of the money. Okay. You could do, Lola says, maybe it was speculating a bounce. That could be, Jim says, maybe a bear call spread. Very well could be, right? There's a number of things that could go on here. What we're going to do, I think I've made my point. These options that we did a couple of weeks ago are out of the money. They're just likely to expire there. But what if you did this over a series of days? Okay, what if you said, okay, today let's go out 14 days. And then maybe tomorrow, what if we do it again? Go out 14 days and kind of be targeting an area where you're taking the opportunity to just kind of layer these in. Okay, so let's take a look at this. Let's go out here, 14 days out. And I think one of the guidelines that Ben uses in this class, we're not necessarily going to follow it today, but one of the guidelines he uses is if the index that we're looking at, we're going to use SPX here today, if it's above the 200-day moving average, then do a put spread. If it is below the 200-day moving average, then he focuses more so on the call spreads. Okay, so really trying to stay aligned with this longer-term trend. And like I said, we might not totally follow that today, but let's see. Okay, we are above the 200-day moving average, so let's start over here on our put side of things. We are 14 days out. And let's maybe target here. Let's see if this still looks decent here. I had some strike prices pegged earlier, but it looks like we're bouncing off the lows, so we might need to shift numbers. Truck makes a point here about the open interest is high, or the volume is high, but open interest isn't. You're right on some of them. Some of them don't have a lot of open interest, but that volume of activity, that started today, so we know there's liquidity out there. That's what that volume is telling us, even though maybe a strike price didn't have 100 contracts in it or whatever, but today it's got 1,000. Then we know there's a lot of activity. And that's why it's really helpful to keep your volume up on things that are a little bit shorter term. Yeah. All right, Chris says 6180. I don't know what about 6180. Let's see, about 15. That would be a 15 delta here. Well, I was looking at earlier, I was looking at 6180, and maybe I said that. I was looking at doing 6180 and spreading it out by 10. Okay. Let's start 6180. It's going to grab the 75, but let's just say sell the vertical. 251 open interest, not bad, right? For doing just a small number of contracts. If you're somebody that likes to maybe do, 20 contracts a shot or something like that, you might look for a little bit more liquidity, or you might have to scale back and just not do as many contracts so that you are not becoming the market. You just want to be a tiny sliver of the overall market. So let's go 6180. And the reason I went there is I am starting about a 15 delta. You don't have to start at a 15 delta. You might fall in love with a 14 delta or a 13 or 17. Okay. For our purposes, and we'll see if this will work. Let's change this to 6170, and oh, good, it's right. It's pretty close to where I wanted it to be. Wanted it to be between 80 cents and a buck, just to kind of balance that higher probability of the option expiring out of the money, having that be fairly high, but also bringing in a decent, quote, decent credit. Okay, so that's what actually I was targeting, between 80 cents and maybe a $1.10. Okay, so 105.1, perfect. It's right in that range. Now, the idea here would be, let's make sure that the strike price we're selling, this 6180, let's make sure it's out of the probability cone. Now, it has 14 days before it expires, but we're not going to plan on being in it 14 days. We're only going to plan on being in it 7 days. Okay, so we could come back to this class next week, and hopefully we would either be out of it already, or we could get out of it. Okay, so let's go make sure 6180 is beyond the cone. It's really what we're looking at here. So here's 6100, here's 6200. And I want to put my mouse, a week from today is going to be the 27th. Okay, so I'm going to get 27th of August right here. And the probability of expiring call, man, I'm getting really close to it. It's about, oh, it jumped on me, 62. Let's go with 6210. So 6210 is about there. So 6180 is just out of range, even just a little bit lower than where that is. Okay, where the probability where it's expected to be, we want to sell where it's not expected to be. Okay. And so 6180, I think that's our final. Let me see if I can get my mouse there. 6180. Oh, I'm so close. 6182, 6178 is in that range. Okay. Pretty close to where my mouse is and that pencil is. Okay. All right. Momo says, is vertical same as credit spread? That's a good question. Vertical, in this case, we are going to make it a credit spread. That's what we put up, doing a short put vertical because we're above the 200-day moving average. However, vertical doesn't just mean credit spread because we could have a long vertical. That could be a debit spread. Okay, if we're bullish, say we might do a long haul vertical here. Could be a calendar spread. Okay, and it's just this idea that you're using different strike prices and you're using it in combination. Some of them, sometimes the main one is a sell or the main one is a buy. And so just the idea that we're mixing and matching with them is, I think, a more generic representation or definition for that spread. Okay, appreciate that. What are the settings of the cone, Chuck says? Let's show you. And Richard says, so I am right. We are risking 900 here. We'll go back and go over the max gain, max loss. Okay. As far as the probability cone settings, come in here. And if you want to pull it up and add it to your chart, super easy to do. Just type in prob. Okay. And that's going to be the only thing that's left is the probability of expiring cone. And so let's go to our gear, go to our settings. It usually comes in at a width of 1. I just like to make it a little bit fatter so it's easier to see. The big thing here, and I think this is probably where Chuck is going, is what's the probability range? Then the default is 68%, and the 68% represents one standard deviation from the mean. And one standard deviation on either side of the mean, there's 34 on either side, combined that makes 68%. And that's where we would expect the majority of the data points on the SPX to reside over a specific time. And then over that time, as time goes on, that range widens, it spreads out. Oh, I didn't want it to quite go quite that way. I'm going to just adjust it here, maybe to about like that. Okay. I do want to see my my August dates here, but it goes out further and further in time. I think that's what you're looking for there, Chuck. If you want some additional aspect of that, okay, go ahead, let me know. All right. I think Cameron's helping me out here as well. So going back to what are we risking? Here, we're looking to get a credit, and the net or the risk on the trade is going to be the difference in the strikes, which is $10 minus $1, now 95 cents. Okay, so essentially, I'll just lock this in so it'll stay there. Basically, yeah, we're risking $900 to make $100. Why would we do that? It would be because of the high probability of it expiring out of the money, that the odds are in the favor that it would do that. Now, if the odds were 50-50, we might not be so interested. We would be, no, I'm not going to risk that much in that case, right? I'm not going to risk, if it was only a 50% probability, that's is it heads or tails type of thing. This is more, okay, it's likely to. It's not guaranteed, but it's likely to. There's a high probability that it would expire out of the money. Okay. Reggie says you could use the expected move shown on the top right corner. Okay. Well, let's go see what you're talking about here. I went in and kind of adjusted how much of the time in the future that we were seeing here. Okay. So you could adjust that. I could come over here to August 27. Let's see if that's the 27 right there. That's the 29th. So I'd have to change it just a little bit. That might be the 27th. Okay, because that's as long as we want to hold it. So you're absolutely right. If you squish it over and kind of bring it in, and then you could go maybe have an easier time pegging what is right there. 65.26 on this side and 62, looks like 62, 30, 62.20, 62.30, something like that. Yeah, absolutely. Okay. Oh, you're just talking on the option chain screen. Oh, okay. All right. Getting back to this, we want to go ahead and place this trade. Do you have to spread it out by $10? No, you don't have to. Okay. We started at a $5 spread. You don't have to spread it out. What some traders might find, though, is if you layer it in and you give a little bit of boundary, say we put it at 61.80, 61.70 today, early in the morning. What if by lunchtime, it's kind of, the index is kind of moved to a different area? Maybe we could layer in, maybe we could put on an additional one, maybe again, focus at a 15-ish delta, again, focusing on getting a credit in the neighborhood of $1. You don't have to do $1, you can choose whatever, okay? That was just kind of a happy medium-ish that I was looking at as far as probabilities and reward, okay? Where is something you feel comfortable with? And you could be comfortable with something totally different, okay? But then say it's moved, it's shifted, okay? Maybe it's only shifted a little bit. Then maybe it would be feasible. Maybe we could come out here and go, oh, well, now we could sell 61.90 or 6,200. In this case, by spreading it out by $10, it gives us a little bit of flexibility here. Now, this one's interesting because this one did have a $5 spread here, but it's not consistent throughout, okay? Meaning we've got 61.50, 60, 61.70, oh, 61.75. This just happens to have a $5 increment in here, but not all of these do. It's like at the 25s, 25 increments, that's where we have an additional one. Okay, strike price that they're putting in there that's just 5 strikes different from the main one. Does that make sense? I hope that makes sense. Okay, but this could give you a little bit of flexibility. Now, if we did keep the 75, that would be okay. You could do that, and then you could use the ones that are in $10 increments. I was just, for my brain, for my purposes, for me, it's a little bit tidier to just try to lay them out very similar to each other. And then the idea would be you wouldn't want to have those strike prices over each other get embedded, meaning if we put on a 61.80, 61.70 here, and then say in a couple of hours, well, this is our short leg, we wouldn't want to go be buying a 61.80. Would want to make sure to spread it out. Does that make sense? And so you could line them up here to begin with, say with a blast all, or you could just kind of keep track and see if it's moved out of that zone that it makes sense that you could layer in. Now, let's go ahead and we'll just throw this in. Let's see what it's worth right now. 95, okay, it's still worth $1. All right, we're gonna go ahead, we're gonna just send this one in. Just gonna do one single contract, but then we could be watching it. Now, if we wanted to, maybe say it didn't change today. Okay, maybe you're like, no, I don't feel like layering today for whatever the reason might be. Okay, then maybe tomorrow you come out here and you go, oh, well, let's go pick the new 14 days to expiration. Right now, that's going to be the September 4th options, right? Because tomorrow those will have 14 days to expiration, and you could kind of follow the process and just kind of lay them in. And really what you're looking for is you don't have the European style option, okay? Well, you have the European style option as opposed to the American style that keeps them from being assigned early or having that kind of that trigger go. It's not going to go before options expiration date. This doesn't happen with these, okay? What if also, I'm going to throw another, consider this out there. What if we said, okay, we'll follow Ben's guideline about putting on put spreads because it's above the 200-day moving average. Could we consider those selling a call spread? We could. You might think of them independently as opposed to just saying, hey, we're going to put on an iron condor. Is you might approach it kind of separately, even though, yeah, together they make up an iron condor. Okay. And we could do the same thing here. And I'm going to go to our 14 days out. But let's come down here on the call side of things. And we could be coming out here, just kind of targeting what is going to be beyond the probability cone. And if we're looking here, I'm going to zoom in a little bit, make this a little bit easier on my mouse skills here. And here is the 27th, so 14 days out. And let's see what it's pretty close to. Let's go. See, it's 65.30 at this point. 65.30. Okay. See if we could sell beyond that. Okay. That we'd want it to be beyond the cone in a range where it's not expected to be. Okay. So let's go 65.30. Let's see if we can find a 65.30 right here. That's about a 13 delta. Now our put side was a 15 delta when we started. This is not so bad. 65.30. Beyond that might be 65.40, 65.50. We've got hundreds here. Let's start with 65.40. And let's see if we sell that vertical, if we get enough here. That's actually, that went to a buy instead of a sell. Let's change that to a sell. We can even go a little further out of the money. Let's go. I take that back. I really want to stay with liquid contracts. It's not as comfortable to go here where there's only 37. It's a little bit more comfortable to be here where it's 437 as far as contracts go. So I think maybe what we'll do, we'll stick with our 65.40, 65.50. It is a little bit richer as far as a little bit over $1.05 credit. But you kind of weigh those options, you know, maybe you'd feel more comfortable coming out to a 7 delta. That is way out of the money. Okay. So think about these concepts in terms of not just doing a particular spread, but maybe doing a series of spreads, right? Or going out to the opposite end, saying, okay, we're going 14 days out. The probability of this option being beyond where we expect it to be could bring in a credit. Some people could consider doing that. Now, I am going to go ahead and I'm going to put this in. I'm going to follow up on it. Okay. And yeah, we'll just throw it out here and know that maybe that one's not ideal, but I do like that it is the $10 spread, keeping it kind of nice and tidy and balanced for my brain. Okay. John says, I'm finding this chart is hard to read as apparently it is too light for an old man. The chart is better. Okay, things must have fixed themselves there, John. Not sure what may have happened there. In any case, if this is appealing to you, if you're like, oh, okay, yeah, index options could be something that I might be interested in, then experiment with different strategies in your own paper money account. Now, today, more than anything, we really focused on the verticals. Yeah, we put on that call spread at the end, making it an iron condor, but it was just the idea that we're looking to sell outside of the probability of where we think that the price of the stock or index in this case might be. Okay, so practice that in your paper money account. I think that's one of the best things that you can do for yourself to learn a strategy is just putting in several over and over and over again. And again, you could use this layered approach throughout the day. You could use a layered approach throughout the week and being consistent how far out in time that you go. In this case, we were just doing 14 days. All right, so I'm going to challenge you to do that. What's the advantage of doing a series of spreads again? It's just the idea that maybe you can, I'm going to say, piggyback on the same index. Okay. Versus, just only doing one at this time. Maybe in your portfolio, maybe you can risk, say, 7 contracts. And then you put the first one on, you're like, okay, let's see how that goes. Okay, it's doing good. Okay, let's put the second one on. Or it could be, oh, that's not going where I expect. Let's put the second one. Maybe it's going to be shifting a little further out of the money than you thought you might go. Or maybe it actually goes the opposite direction. Okay. But you would definitely want to practice it. Okay. Doing this layering in methodology. All right, you guys. Cameron, thanks for helping me out today with questions. We're going to have a short little break, and then coming up next is going to be Brent Morse, who's going to be doing managing an options portfolio, which index options could help you with your options portfolio with some of these strategies. Okay, you guys, appreciate your attendance here today. I did not see a survey, but follow us on X, be a subscriber. That makes it so much easier to find our content. We'll see you at the top of the hour. Bye-bye.